Hi everyone, this is Ankur from FinstudyClub, welcoming all viewers to the session on temporal method. Basically, it's a corollary that we'll be discussing now, and we'll be looking at the finer points as far as the inventory valuations is concerned. Now, under this particular session, I'm going to just talk about one very specific point, and that specific point is what is written here. We need to marry the time zone of the prices and the forex rates. That's the only learning that you're going to get out of this, like a 5-minute session. What I'm basically trying to say is that under temporal method, you would recall that inventory being a non-monetary item, you need to make a historical tagging to it. Historical tagging as in, you will have to go back to the date of purchase and you'll have to use the same exchange rate that was prevailing then to make a conversion today. Now, in that tagging, you have to just be a little careful about the method of inventory valuation which the local currency or the subsidiary has used. What I'm basically trying to say is, if you just look at the timeline here, and this is, let's say I call it January and this is December. If my subsidiary in the local currency, let's say euros, is following FIFO method, forget about exchange rate. I'm talking about the valuations in euro itself. In the P&L account where COGS would have gone first in, first out. So prices of the initial time period would have been into COGS. So what I'm trying to say is that when you convert the COGS of euro into COGS of dollars under the temporal method using the historical tagging, then I will have to use the exchange rate prevailing in the similar time zone, if not same exactly, but in the similar time zone to make that conversion. So if, let's say, I give you the exchange rate, 1 euro is equal to 1.1, 1.2 on an average, and 1.3 towards the end. So if my FIFO is valued, my FIFO is valuing COGS at the initial prices, let's say prices prevailing in Jan-Feb, then I will have to use the exchange rate also, which is prevailing in Jan-Feb. So I'm going to do this conversion at 1.1. On the other hand, the FIFO will value the closing stock for the purpose of balance sheet at the recent most prices. That's the characteristic of FIFO, first in, first out, and whatever is left, is valued at the latest prices. So the exchange rates also should be the one which are prevailing in the similar time zone. So again, the prices is that the time zone of the prices in local currency, be it yen, be it any currency, and the foreign exchange rate of that with my home currency should be of the similar time zone. That's broadly the point. Okay, so it says that the historical prices. What do you mean by historical prices? You tag it historically. In the domestic currency, let's say dollar is equal to the historical prices in the local currency. Whatever is the price, let's say 12 euros. Prices were, let's say, like 15 euros during the year, and closing were they like the 18 euros. So let's say if I'm talking about COGS, the local currency value is 12 euros, and the exchange rate also that you're going to use is 1.1 dollars per euro. So euro gets cancelled, and 1.1 into 12 is equal to 13.2, something like that. There is a point that is written here. Actually, I have a lot of examples, so I will come to this point, but let me just touch upon that. Now, inventory is not like a plant and machinery wherein you are going to purchase it only once for all, or let's say once in a year. You keep on buying inventory, on a daily basis. Remember what my current rate method says. All P&L item at the average rate. Now this average rate has to be of the entire year, by the way. It's a 12-month average. I'm going to compare this situation with the one that I have drawn here. I am not valuing my COGS or closing stock at a rate prevailing on a particular date. That is possible only if I buy something like a machinery, because it's a very specific to a date. Inventory is being bought over a period of time, so I might have to match the time period, I might have to take the average of that particular time. But please, this average of that particular time is not equal to the average rate for the entire year. Similarly, the average prices prevailing in December, that will be used to value the closing stock, because obviously again the stock must have been purchased on regular basis. So I will have to take the exchange rate also prevailing throughout December, not throughout the year. Okay, so sometimes it gives you a feeling that the question, let's say specifically core books, they give you a sense that the average of the January was being taken. Now fact of the matter is, you're taking the average, but you're not taking a 12-month average. So that doesn't mean that you're starting to follow current rate method. It is still temporal method. Why do you take the average of January or average of December? Because your inventory purchase happens on an average. Okay, so let's just look at four practice examples that I have for you, very small on a similar pattern, but there will be a learning point in each one. Find out the value of the closing inventory and COGS in the reporting currency, which means you have to finally calculate the value in dollars. Under the temporal method, that means we'll have to do the historical tagging if the subsidiary follows FIFO. Now, with the information given so far, I'm not even, actually subsidiary also hasn't made his own accounts. So let me just make his own accounts first as far as the local currency is concerned. So my subsidiary is following euro. There is one unit purchase of 10, the other one purchase of 12. So every time you're purchasing one unit, so it's P1, it's P2. Now if you're selling one unit, in case of FIFO, I'm following FIFO, the subsidiary is going to value this at 10 euro and the closing stock at 12 euro. Subsidiary is not bothered whether the conversion or remeasurement or translation, any of that will happen. Subsidiary, why would they be bothered? Now the question is, the moment they write 10 and 12, they make their income statement and balance sheet, and that's where the accountant of the subsidiary's work gets over. Now, point is, what is the rate at which this 10 should be remeasured? I'm talking about temporal methods, so I'll have to be very specific about my terminology. This 10 will have to be historically tagged. This belongs to the earlier time period. It is purchase 1. So I'm going to take the older rate, the rate prevailing at a time zone of which I have taken the prices here. Similarly, 12 will be converted at a rate which was prevailing later in the day. So it is 1.2 and 14.4 is the total dollar value. Okay, let's talk about more such examples. So it's pretty similar example. The only difference here now is that you're following FIFO. The subsidiary is following FIFO. Now what change does it make? Yes, there is certainly a big change, because now the valuations in the local currency itself will change. In case of LIFO, the last in will be first out. Now what is the value at which they will be converted? Again, because it's temporal method, you will have to tag it historically. So this 12 belongs to recent prices, therefore I'm going to use 1.2, and this 10 belongs to older prices, I'm going to use 11 and 14.4. Now there is sometimes a confusing point that the exam comes up with. Let's read through. Similar example, the only thing is that now the conversion is happening not by remeasurement but by translation. Now in this case, is there a need for historical tagging? Answer is a big no. But anyway, let's just complete the accounts of the subsidiary in the local currency. It's FIFO, so first in, first out, and the closing stock is at the recent prices, 12. Now to convert this 10, if the historical tagging has to be done, then it needs to be taken back to the older rates, but this time I have to follow the current rate method, in which case the income statement item will be converted at the average rate prevailing all throughout. And the closing stock doesn't matter whether the subsidiaries followed FIFO or LIFO. That will affect this 12. But my conversions will not be affected by the method that is being followed, because under current rate method we just have to follow the closing rate. That's it. 12 and 15.6. Okay, imagine the subsidiary was following LIFO, but the current rate method was to be followed. Now, whatever is the value that will come in the income statement will be converted at average rate, and the balance sheet will be converted at closing rate. In case subsidiary is following LIFO, this 10 is going to come here, and it is following the closing stock will be valued at recent most prices, but the rates that you are using will not have to be tagged historically. Okay, so I hope that this confusion is clear now. When to use the closing rates and when to use the average rate. Just be a little careful in reading the question. Okay, the question might be there for temporal, or it might be there for the current rate method. So with that, we are at the end of this particular session. I hope this was useful. Should you have any queries, write to me at ankur.k@finstudyclub.com. Thank you.